In 1995, a terrifying static noise echoed through living rooms across America. Dial-up internet was logging on, slowly, painfully, and magically. It was a glitchy, glowing mess that took 5 minutes to load a picture, yet everyone who used it agreed they were looking directly at the future. Wall Street heard the word online and reacted like a dog hearing a chip bag open. Venture capitalists, fueled by optimism and decaf lattes, started pouring billions of dollars into any company with a name ending in .com. To get a $100 million valuation, you didn't need a product. You just needed a terrible idea, a Microsoft Paint logo, and the ability to say the word scaling in a pitch meeting. No one asked about profits because the explicit goal was massive size at any cost. During this initial phase, the actual math of running a business was ignored. Investors were betting entirely on the hype and the promise of a digital utopia. This lack of logic created a market where absurd pitches secured massive funding. Startups with zero products bought Super Bowl commercials begging people to please clap for their website launches, while others pitched AI toilet seat trackers and walked away with hundreds of millions. The ultimate symbol of this financial mismanagement was Pets.com. They burned through $300 million of investor cash on marketing, becoming famous for this sock puppet mascot, while simultaneously selling 50-pound bags of dog food at a massive loss. This institutional exuberance trickled down to the mainstream public. Teenagers started day trading from their bedrooms. Your aunt with the Crystal collection bought tech stocks, and a booming market made everyone feel incredibly rich on paper. By 1999, the dot-com boom had morphed into a mass financial delusion disguised as technological progress. Then, in March 2000, the euphoria broke. After the market hit an all-time high, a few companies started missing their earnings targets. Suddenly, the narrative shifted, and aggressive questions came roaring back into boardrooms. Investors suddenly remembered basic economics. They started demanding concrete answers about actual revenue, the exact size of the customer base, and whether these digital empires were actually capable of turning a profit. This chart maps the Nasdaq index during the fallout. The line plunges 78% over 2 years, dropping from 5,048 down to 1,114. That steep decline represents $1.7 trillion in market value completely vanishing. The wreckage was immediate. Offices emptied, stock options became worthless paper, and engineers threw their foosball tables into dumpsters. The tech sector became radioactive, causing enrollment in university computer science programs to plummet by 30%. The crash wiped out massive amounts of wealth, but it also shattered the naive belief system surrounding the internet's potential. While the noisy startups collapsed, a handful of companies survived. They did it by ignoring the panic and methodically focusing on engineering and logistics. Amazon's survival strategy was brutal and effective. Jeff Bezos slashed unprofitable ventures, cut costs, and focused relentlessly on executing a single goal: getting products to customers faster and cheaper, without any flashy gimmicks. Meanwhile, Google entirely avoided the Wall Street spotlight. Operating out of a garage with no commercials and no IPO, Larry Page and Sergey Brin kept their heads down, quietly refining search algorithms to make the internet actually useful. The single metric separating these survivors from the casualties was cash flow. They prioritized having real customers and a working business model before they attempted to scale. Success in the following years required a focus on mechanics rather than visions. Growth became tied to solving specific consumer problems and proving demand before spending $1 on expansion. The dot-com crash wiped out thousands of companies, but it left behind a hidden, highly valuable legacy: physical infrastructure. Before they vanished, investors poured billions into laying millions of miles of fiber optic cables, massive data centers, and heavy server racks. Like Roman roads outliving the empire, this internet skeleton stayed behind, unused but functional, waiting to carry the next wave of traffic. A few years later, platforms like Facebook and YouTube capitalized on this cheap, abandoned infrastructure. They built global networks out of dorm rooms and garages, entirely bypassing the need for the wild venture capital funding of the 90s. The wasted billions of the late 90s essentially acted as a massive, accidental crowdfunding campaign for the physical backbone of the modern internet. In 2007, the internet shifted from a place you visited on a desktop to a continuous state of living. The launch of the original iPhone created a portable, personal gateway to the web. The surviving, highly optimized tech titans leveraged this new mobile access to embed themselves directly into the rhythm of daily life. Google became a verb. Amazon redefined convenience. By solving real problems, these platforms left the speculative bubble era permanently behind. The 2000 collapse acted as a filter. By removing the speculation, it cleared a path for a more disciplined version of the internet to take hold.